There's a statistic that has been circulating on financial social media for years, and it goes something like this: members of Congress beat the stock market by 12% a year. They have access to classified briefings, they write the laws that move entire industries, and they use that information to get rich while the rest of us are left guessing. It's a compelling story. It fuels viral tweets, best-selling books, and a growing industry of financial products designed to copy what lawmakers do with their own portfolios. As of March 2026, retail investors had poured at least $650 million into vehicles specifically designed to mirror congressional trades. $650 million, betting that the people who write our tax code know something we don't. But here's the question that rarely gets asked in those viral posts: is it actually true? Let's look at the real numbers, because the answer is much more interesting than either side of this argument would have you believe. In 2025, the S&P 500 returned 16.8%. That was a strong year, not spectacular, but solid. According to data compiled by Unusual Whales, a firm that tracks congressional stock disclosures, 29 members of Congress beat that return. 29 out of the hundreds who file disclosures. Republicans in Congress averaged 17.3%, Democrats averaged 14.4%. And across all disclosed portfolios, only about 32% of lawmakers beat the S&P 500. That means roughly 68% of members who trade stocks underperformed a simple index fund. That's not a conspiracy. That's a bell curve. But, and this is the part that keeps the debate alive, some individual members have posted numbers that are genuinely eye-popping. Representative Warren Davidson of Ohio returned 78.8% in 2025, more than quadruple the market. Representative Donald Norcross of New Jersey returned 70.8% with a portfolio that held exactly two stocks, Senior and Toronto Dominion Bank. Representative Terry Sewell of Alabama returned 67.9%, driven largely by an April Nvidia purchase that caught the AI infrastructure wave. And Representative Brian Steil, the same person who chairs the House Administration Committee and introduced the Stop Insider Trading Act, returned 62.5% on a concentrated bet on General Electric and Caterpillar. That last one is awkward. The person leading the charge to ban congressional stock trading was himself beating the market by almost 46 percentage points. Then there's Ro Khanna. The California Democrat has been one of the loudest voices calling for a ban on congressional stock trading. He has stated publicly that he does not personally trade stocks and has no input into the trades made by his wife's trust. And yet, according to an analysis by ProCap Insights covering January 2024 through April 2026, trades associated with Khanna posted a staggering 112% excess return over the S&P 500. That's more than double the market, and it actually surpassed Nancy Pelosi's 38.5% outperformance over the same period. Khanna's office maintains that the trades are handled entirely by third-party advisors without his involvement. But the optics are difficult to defend, and his critics have noted the contradiction between his legislative position and his family's trading results. Nancy Pelosi herself remains the most famous congressional trader. A New York Times analysis found that when she first entered Congress in 1987, she and her husband reported between $610,000 and $785,000 in stocks. Today, Quiver Quantitative estimates that portfolio at $133,700,000. That is an increase of roughly 16,900%, compared to about 2,300% for the Dow Jones over the same period. The average annual return comes out to about 14.5%, compared to 7 to 9% for the major indices. Consistently beating professional money managers over decades is rare. Beating them by that margin is almost unheard of. But the academic evidence on congressional trading is more nuanced than the headlines suggest. The landmark study on this question was published by Ziobrowski, Cheng, Boyd, and Ziobrowski in the Journal of Financial and Quantitative Analysis. Examining Senate portfolios from 1993 to 1998, they found abnormal annual returns of approximately 12% over the market. A follow-up study on House members found about 6% annual alpha. Those are large numbers. They suggest an information advantage that goes beyond luck or skill. However, a more recent working paper by Chen-Sacerdote and Chen-Sacerdote of Dartmouth, released in 2026, challenges this narrative. They examined every disclosed congressional trade from 2012 through 2023, covering 334 legislators and roughly 71,000 transactions. Their finding was stark: the average lawmakers' trade slightly underperformed the market, lagging the broad market by about 26 basis points over a full year. When they looked at the groups you would most expect to have an information edge, frequent traders, party leaders, and legislators trading in industries overseen by their committees, those groups actually performed worse, not better. Party leaders' trades underperformed by about 4.4 percentage points. Trades in committee-matched industries underperformed by about 2.8 percentage points. The researchers then asked a different question. Instead of looking at whether lawmakers beat the market, they looked at whether lawmakers timed their trades around information. They compared every trade against professional analyst recommendations using the IRB-THES database, which standardizes brokerage ratings from strong buy to strong sell. The pattern was clear: when the professional consensus was most bearish, lawmakers bought less. When consensus was most bullish, they bought more. In other words, they were following the same signals available to everyone. And then they did something even more revealing. They looked at 500 million posts from StockTwits, the social media platform where retail investors discuss stocks. They measured how much attention each stock received in the weeks before and after a congressional trade. The finding: the tension on a given stock rose in the weeks before the trade, peaked in the trade week itself, and then declined afterward. Lawmakers were not trading ahead of the crowd. They were trading with the crowd. They were buying stocks that retail investors were already talking about, near the peak of the attention cycle. That finding is important because it directly contradicts the insider trading narrative. If members of Congress were systematically using non-public information, you would expect them to trade before the crowd, not with it. You would expect their stocks to rise after their purchases, not be flat or declining. The Chen-Sacerdote data suggests that, on average, the information advantage narrative is not supported by the evidence. So where does that leave us? The picture is more complex than either the conspiracy theorists or the defenders would like. There are individual members with extraordinary returns that are difficult to explain by skill alone. Pelosi's lifetime track record, Khanna's 112% over 2 years, the handful of members who consistently double the market, these are real data points that raise legitimate questions. But the aggregate evidence shows that most lawmakers who trade do not beat the market, and that their trading patterns look a lot like what you would see from ordinary retail investors scrolling through financial social media. This matters for 2 reasons. First, the $650 million flowing into copycat congressional trading products is almost certainly a mistake. If lawmakers are buying what retail investors are already talking about, copying their trades means buying stocks after they've already peaked in attention and price. You are not getting the inside scoop. You are getting a lagging indicator with a 45-day reporting delay baked in. Second, the legislative push to ban congressional stock trading is still very much alive. The Stop Insider Trading Act, introduced by Representative Steil in January 2026, would prohibit members from purchasing individual stocks and require 7 days public notice before any sale. But it has been criticized as a paper tiger. Critics point out that it allows members to keep all their existing holdings, permits trading in commodities and private securities, and leaves a loophole for spouses and dependent children to trade on behalf of third parties. A competing proposal, the Restore Trust in Congress Act, would ban stock ownership entirely and require divestment within 180 days. That bill has bipartisan support but has not advanced. Polls consistently show that about 86% of Americans want Congress to prohibit its members from trading stocks. That includes 88% of Democrats and 87% of Republicans. The political pressure is real. But the legislative process has been slow, caught in the usual Washington dynamics of competing proposals, leadership priorities, and election year calculation. Here's the bottom line for someone watching this from outside. The evidence does not support the idea that Congress as a whole systematically exploits insider information to beat the market. Most of them can't. A full 68% of lawmakers who trade stocks underperformed the S&P 500 in 2025. Their trades correlate with retail chatter, not classified briefings. But that doesn't mean the system is working. The handful of lawmakers who do generate extraordinary returns, whether through skill, access, or just dumb luck, create a perception problem that erodes trust in a way that aggregate statistics cannot fix. And trust matters, especially now. In 2025, members of Congress made over 14,000 stock trades totaling $720 million. That is a staggering volume of financial activity by the same people writing the laws that govern those companies. Even if most of those trades are perfectly innocent, the volume alone creates an unavoidable appearance problem. The most practical takeaway for your own finances is this: don't try to copy congressional trades. The data suggests you are following a crowd that is already there, and you are arriving 45 days late due to the Stock Act's disclosure window. By the time a trade appears in a filing, the stock has already moved. Instead, focus on the strategy that actually works for the overwhelming majority of people: low-cost index funds, consistent contributions regardless of market conditions, and a time horizon measured in decades, not news cycles. That boring approach has beaten most of Congress, most of the time. It does not require classified information, and it does not require you to file any disclosure forms. One final thought. The debate over congressional stock trading is ultimately a debate about trust in institutions. When 86% of Americans want something and the legislative process cannot deliver it, that failure itself becomes part of the story. The data is complicated, some lawmakers outperform, most do not, and the average looks ordinary, but the perception is simple. People see what Pelosi and Khanna and others have done with their portfolios, and they draw their own conclusions. Whether the math fully supports those conclusions or not, the erosion of trust is real. And in a system that depends on public confidence to function, that might be the most expensive cost of all. This has been Wealth Unlocked, financial literacy education, not investment advice.